Welcome to Talk Tickers. Today, we're diving into Accuray's first quarter fiscal 2026 earnings call from November 5th. Now, this was a really critical one, folks. You've got a new CEO stepping in and a ton of questions swirling about the company's future. So, at first glance, things didn't seem so bad. The company actually posted a revenue number that beat Wall Street's consensus by about 3%. But the market's reaction was, well, swift and absolutely brutal. The very next day, the stock plunged nearly 16% on trading volume that was triple its daily average. Ouch. Okay, so this is the central mystery we need to unpack. A top-line beat, followed by a massive double-digit drop. That's a huge red flag. It tells you right away that the headline number wasn't the real story. So, what was going on under the hood? Right, let's peel back the layers. When you look past that revenue figure, the financial picture gets a whole lot darker. It reveals several key areas of weakness that completely overshadowed that small beat. So the first major issue was profitability. It just wasn't there. The GAAP earnings per share came in at a loss of 18 cents. That's a massive miss compared to the 6-cent loss analysts were bracing for. Even more importantly, adjusted EBITDA, which is a measure of core profitability and it's the company's favorite metric, it swung from a $3.1 million profit last year to a $4.1 million loss this quarter. That is a huge and very negative swing. Now, this slide really tells the tale of two businesses within one company. On one hand, you have the high-margin, predictable service revenue, the good part of the story, which grew a pretty healthy 7%. But on the other hand, you have the lumpy, capital-intensive product revenue, which just absolutely collapsed. It fell 23% year over year, and that is the source of all the trouble. And you can see here how that product weakness just infected the entire income statement. Gross margin got crushed, falling over 500 basis points. Gross orders, which is your key indicator for future sales, fell by nearly a third. And the total backlog, that's their book of future business, it shrank by 16%. It all just culminated in the net loss ballooning from $4 million last year to nearly $22 million this year. So, in response to these pretty grim fundamentals, the new CEO, Steve La Neve, used his very first earnings call to announce a major strategic pivot for the entire company. And he did not mince words. He called this a transformation year. The message was crystal clear. The status quo just isn't working anymore. The focus is shifting away from just selling units to now driving profitable, sustainable growth through much better execution and discipline. So the plan itself is basically this three-pronged strategy. First, they're going to be more selective in their sales, basically walking away from low-margin deals, especially in places like China and Europe. Second, they're cutting costs aggressively to match their expenses to this new sales reality. And third, they are doubling down on that growing high-margin service business we saw a minute ago. And to their credit, management put some specific targets on this plan. They're aiming to get back to a high single-digit adjusted EBITDA margin run rate within a year. And the goal is to hit double-digit margins over the medium term. These are pretty ambitious targets, especially given they're starting from a negative $4 million this quarter. All right, now let's look at the road ahead, because this is where things get really interesting. Despite that disastrous Q1, management surprised a lot of people by holding firm on their full-year guidance. Yep, they reiterated their targets for both revenue and adjusted EBITDA. What this implies is that they expect a massive turnaround in the next 3 quarters to make up for this really weak start and somehow still hit these numbers. And this slide really visualizes the Herculean task they have ahead of them. The CFO said it outright on the call. They expect revenue to be split 40% in the first half of the year and 60% in the second half. A plan that is this back-end loaded carries just enormous execution risk. Essentially, everything has to go perfectly from here on out. The analyst Q&A session didn't really provide much relief either. Management confirmed the macro environment in their key regions is still tough, and that product margin pressure is going to continue right into the second quarter. They believe some delayed orders will finally close in the back half of the year, but really that just reinforces the high-stakes bet on that big second-half recovery. So, let's put it all together. What's our final verdict here? And what should we be watching for in the next quarter? Look, we don't expect a quick fix. Q2 is probably going to look a lot like Q1, with challenged orders and that persistent margin pressure. The stock is now firmly what we call a show-me story. Until management can deliver some real, tangible proof that this transformation is actually working, the stock will likely just stay range-bound. So we're rating it market perform, as the risk and reward seem pretty balanced at these levels. Now, for those of you looking for a potential trade idea, here's a classic hedge fund-style pitch. Accuray has dramatically underperformed the broader medical device sector, which has been pretty stable. This suggests their problems are company-specific, not driven by the whole market. So a pairs trade, going long a broad medtech ETF like IHI while shorting Accuray, is a bet that this divergence continues. It lets you isolate the company's execution risk while hedging out any broader market moves. All right, and before we wrap up, just the usual friendly reminder, this is not financial advice, so please be sure to do your own research.